Hey folks, Dividend Gardener here. Welcome to Dividend Gardening. I love sharing investing game changers that can help smaller Canadian investors, especially Canadian dividend investors. And here is yet another one, in a year where we've already seen fractional shares and a Big Six bank brokerage going commission-free. Today we're talking about CDRs. No, not those things you used to make mixtapes with before the days of streaming music. I'm talking about Canadian Depositary Receipts. These receipts represent a fraction of a share for a stock that you can't buy on Canadian exchanges. That's the key word here, exchanges. You might be able to buy these stocks with Canadian brokerages, but at that point you're dealing with a non-Canadian exchange like the New York Stock Exchange or the NASDAQ. A CDR lets you access these international stocks using a Canadian exchange, which means that you're able to buy and sell in Canadian dollars, even though these aren't Canadian companies. The idea of a CDR is new, but the concept of a depositary receipt is not. In fact, if you do a lot of international investing, you might already have one in your portfolio. Dividend stocks like Toyota, Unilever, and Philips, these aren't American companies, but they trade on the New York Stock Exchange through ADRs, or American Depositary Receipts, in US dollars. For a Canadian investor to purchase these stocks directly, you'd have to convert your Canadian dollar to the currency of that exchange and have a brokerage that can give you access to that exchange in the first place. Aside from interactive brokers, I'm not even sure if any Canadian brokerages provide direct access to exchanges like these that are outside Canada and the US. If they do, they don't really advertise it very well, and maybe that just speaks to a lot of investors just keeping it simple and buying the ADR version instead. To summarize, depositary receipts like CDRs and ADRs provide an accessible way to invest in stocks that might be difficult or impossible to purchase in your own market or using your own currency. So how do CDRs work? And is holding a CDR as good as owning the underlying stock? The CDR was introduced by CIBC, specifically CIBC Capital Markets. Their role here is to manage the lineup of CDRs. Legally, they refer to themselves as the custodians of the CDRs, so that's the term I'll use from here on out. As the custodians, CIBC holds the underlying shares of the stock in trust. When you buy a share of a CDR, you're getting a receipt for a fractional share of this stock. CIBC launches each new CDR at $20. So for a stock like Amazon, you'd be getting a very, very small fraction, whereas for a stock like Apple, you'd get a larger fraction, but still smaller overall. Even though, as CDRs, these do trade at similar dollar amounts. The calculation CIBC uses to figure out just how much of a share each CDR holds is called the CDR ratio, and this changes every day based on how the Canadian dollar changes in value relative to the US dollar or whatever the underlying currency of the stock happens to be. This provides what's called a hedge. This isn't something I made up for the channel, it's a real investing term, and hedges are meant to provide some stability when currency fluctuations can have a big impact on your investment. We'll talk more in depth on how the hedging on these CDRs can affect your returns later on. So, the underlying number of shares can vary, but what about the share price? As you can see here from this chart, using Amazon as an example, the Canadian price moves almost identically alongside the US share price. There are some small anomalies that we see here in the early days, and CIBC's Elliot Schurer explained that this is because there was less trading volume at the time, which makes sense given that this was a fairly new choice for investors in the first few months. But all in all, I'm not too concerned about that. I am a buy and hold forever, or at least a buy and intend to hold forever investor, and worrying about minor fluctuations between these two share prices isn't worth missing out on an investment that I think would be beneficial for me to hold. Now, the big question. If I hold a Canadian depositary receipt, is it roughly the same as owning the underlying stock? And the answer is yes. Pretty much everything that goes along with owning a stock also applies to owning a CDR. You get voting rights just as you would with a stock. You can hold your CDR in an RSP, RESP, or TFSA. You'll still pay capital gains tax on any gains you've made when you sell. But most importantly, and the reason why I'm talking about this, CDRs pay dividends. If you're a shareholder or a CDR holder, on the record date, you would earn a dividend equivalent to the CDR ratio of the underlying stock times the number of CDRs you hold. And because it's a CDR, it'll be paid out in Canadian dollars. That being said, because it's just like holding the underlying stock, the foreign withholding tax still gets deducted as well. In Canada, on US stocks, that's 30%. But if you fill out and file a W-8BEN form, that drops down to 15%. It's just the cost of having a diversified dividend stock portfolio. Next, a question that's on a lot of people's minds whenever a new financial product is introduced. Are there management fees? And if so, what are they? It turns out that there are no management fees on CDRs. CIBC doesn't charge any. But as you might expect with CIBC taking a more active role on the currency side of things, they do earn revenue in the background from managing the currency hedge, and this is capped at 0.6% a year. Consider that many retail investors pay currency conversion fees that average 1 to 1.5%. It makes sense to save on fees as much as possible, but the fact is, whenever currencies are being converted, someone is making money off of that conversion, and at least CIBC is being upfront about that. Plus, keep in mind that the 0.6% per year is applied to an institutional currency conversion rate. A giant bank like CIBC is always going to be able to access a way better rate than I, an individual investor, ever could. The CDRs launched by CIBC are traded on the NEO exchange, not the TSX, so be mindful of that when you're searching up the ticker symbols. You also can't hold them if you're considered a US person for tax purposes. Other than that, CDRs trade just like any stock or ETF. You can set limit orders, market buys, market sells, it's just that simple. If you're enjoying this video so far or you've learned something, please plant a like on this video. It really helps the channel to grow. And just like a CDR, these likes are hedged, so the value of one like always equals one like. Thank you so much, and now let's dive into the pros and cons of CDRs. One advantage is they're an easier gateway into international stocks. Canadian stocks only represent 3% of the world's market, but it's easy to end up with a portfolio overweighted in Canadian stocks for a number of reasons, and I'm speaking from experience here. It took me 6.5 months since I made my first investment to finally add a US stock to my portfolio. I know it doesn't really help to go back and say, what if I did things this way? But the fact is, if I had made that purchase from day one, I'd have been way better off today. But I didn't, and it was because of the fear of losing 1.5% right off the bat on a full share, no less, and potentially losing another 1.5% down the road. I just didn't think to invest in anything that I couldn't get commission-free. But if a $20 CDR had been available at that time, I think I'd have been invested in US dividend stocks way earlier on. Another advantage of CDRs is that the purchase price is lower because each receipt corresponds to a fractional share of an underlying stock. If we go back to that Amazon example, there's no way I could buy a share outright at $3,200 give or take right now. But I feel like I could gradually build myself a position with a CDR version at 20 Canadian dollars. And finally, because CDRs are hedged, the value of the underlying stock isn't affected by changes in exchange rates between the Canadian and US dollars. CIBC's own diagram shows how this can be an advantage. If you hold Apple, the NASDAQ unhedged version, and Apple appreciates by 40%, but the Canadian dollar also increases in value by 10%. Suddenly, your Apple gain is really only 26%. But if you're invested in the CDR of Apple, those 40% gains remain 40% gains, approximately. That being said, there are some drawbacks to CDRs as well. For one thing, they're hedged. Yes, hedges can also be a potential disadvantage. We covered what happens when the Canadian dollar increases in value from your initial investment, but using the same example, what if the Canadian dollar decreases in value relative to the US dollar? A stronger US dollar means your unhedged Apple stock would now have appreciated 54%, which definitely beats that 40% return on the CDR. Whether or not a hedged investment is the right move for you is beyond the scope of this video, and also I can't predict currency values. But it's important to be aware of the potential upsides and downsides. Another drawback is that you can't buy fractional shares of CDRs themselves yet. At the time of recording this video, there are 2 brokerages who offer fractional shares of US stocks in Canada: Wealthsimple Trade and Interactive Brokers. And even though Wealthsimple Trade does offer fractional shares of some Canadian stocks as well, considering a large part of their revenue comes from the currency conversion fee on US stocks, I think it's highly unlikely that they'll add CDRs to their fractional trading lineup. If they do, that's great, but I would be pretty surprised. But with CDRs launching and trading at around $20 a share, I think that's still a pretty accessible starting point for a lot of Canadian investors. And lastly, you can't trade when markets are closed on Canadian holidays, even if the underlying stock is still trading. When I was writing this video, it was Thanksgiving Day in Canada, and although it was trading as usual in the United States, in Canada the NEO exchange was closed. This isn't a deal breaker for me, but if it matters to you, then it's something to take note of. At the time of this video, there are 23 CDRs available, with the latest 5 having joined the lineup this past Wednesday. Out of these 23, we have 13 dividend payers. 14 if you still count Disney, which many dividend investors still do, but it did suspend dividend payments since January 2020. We have Apple, ticker symbol AAPL, Bank of America, ticker symbol BOFA, Costco Wholesale, ticker symbol COST, Goldman Sachs, ticker symbol GS, The Home Depot, ticker symbol HD, IBM, ticker symbol IBM, JP Morgan Chase, ticker symbol JPM, MasterCard, ticker symbol MA, Microsoft, ticker symbol MSFT, NVIDIA, ticker symbol NVDA, Pfizer, ticker symbol PFE, Visa, ticker symbol Visa, and Walmart, ticker symbol WMT. One important thing to note is that while CIBC tries to match the ticker symbols as much as possible to those of the underlying exchanges, there are a few notable differences. Generally, the ticker symbols differ when there are already other stocks trading on the NEO exchange that have these ticker symbols, so be mindful of that. These 23 CDRs are just the beginning. If you look at the prospectus supplement that CIBC had released earlier, there's actually one CDR that has yet to launch, and that is Johnson & Johnson, ticker symbol JNJ, also a dividend stock. While CIBC hasn't stated anything about why they're holding off on launching the J&J CDR, one could assume it's because Johnson & Johnson is spinning off its consumer business at some point, which could add some complexities when it comes time to split the new company into its own CDR. I'm not 100% sure, but that would be my guess. Beyond that, CIBC launched its current lineup in small groups every 6 to 8 weeks or so. So while there's no indication of any new CDRs coming out at the moment, it wouldn't be a surprise to me if we were talking about new CDRs later in 2022. To sum it up, CDRs can be a more accessible way for smaller investors to add more US exposure to their dividend gardens. And if you can pair your purchases to a commission-free brokerage, even better. One thing that I didn't get a chance to cover here is how I track CDRs in my portfolio. That'll be a topic for one of my next videos. I'm curious to know your thoughts about CDRs, and if you'd like to see more in-depth videos about dividend-paying CDRs in the future, let me know in the comments. Thank you to everyone who has planted a like to help the channel grow. It's not too late if you haven't already. Thank you so much again for helping the channel to grow. I really do appreciate it. And of course, don't just invest based off of this video alone. I'm not a financial advisor, and I make these videos for informational and entertainment purposes only. Always do your own due diligence on the CDR and on the underlying stock, or seek the advice of a licensed financial professional. Thank you so much for watching, happy dividend gardening, and we'll see you in the next video.